majorly, it's actually interpretation of financial statements. And a major tool for interpreting financial statements is through ratios. Ratio is not the only tool that you can use to analyze financial statements. Statement of cash flows that you learned with Mr. Biodun is also a tool that we can use to analyze financial statement. But for now, what you need to learn is how to prepare statement of cash flows, not majorly how to use it for analysis. So my focus or your attention for FR is how to use ratios for analysis. That's what we're going to be looking at this evening. The approach I want to suggest we use for this class is we use a stone to kill two birds. Let's use a past question approach because I see that most of your questions literally request for almost all those ratios. So while we solve past questions, would also have opportunity to learn the core principle at the same time on ratio analysis. And remember, I promise you that from today going forward, that a major part of our classes is going to be past questions. So, and I'm going to effectively start that today. Even next week, past questions we'll be looking at majorly. While that class for Thursday is just for us to touch on the little few standards that we have left to complete our syllabus. But by now, you need to start getting familiar with how questions are asked. So last diet, ICAN asked 3 questions around ratios. I'll be solving 2 of them. The third one is EPS. It's also ratio as well. So if we're able to achieve those 2 tonight, then yeah, we can go and rest. So I hope you're able to achieve that early enough. So before we jump into this question, see, when it comes to ratio analysis, there are majorly 5 classes of ratios that there are. And we have profitability ratios. We have efficiency ratios. There is the liquidity ratios. There is the solvency ratios. And we have investors ratios. So your exam requires that you can compute these ratios conveniently because you're going to find it there every diet. This diet, you find it there. So it's important you're able to compute it properly and correctly. And also be able to do some analysis. So last diet, this was question 2 under section B. So mostly you find it under questions as question 2 in section B of your exam. This is a question. If I want to go straight to the requirements, because for your exams, I would advise that you'd start with the requirements of the question first. When you have read the requirements of the question, then you can then go to the body. Because this gives you a sense of an understanding of what you are required to do while reading the question or the body of the question. So this question asks you to compute the following ratios for ORAC Nigeria Limited. There are quite a number of ratios, 12 ratios for 12 marks. Of course, that goes to show that 1 mark per ratio, right? 1 mark per ratio. And the examiner also wants you to analyze the position and the performance of ORAC Nigeria Limited for the year ended September 30th, 2023, and determine if Datamatics PLC Datamatics PLC investment in ORAC will be worth the while. While the A part is asking us to compute, the B part wants you to analyze. And they are ready to give you 8 marks for the analysis. So tonight, I simply want to show you how to get 20 to 20 over 20. Because ratio is one part of your exam. This last diet. So ratio is one part of your exam that you can easily get 20 over 20. You can easily get it. From the computation, you can get everything correctly. The analysis, I'll teach you how to pick up the most of the marks in the exam without wasting too much time. So again, you see, have it in mind that when you have a question of 20 marks, the exam itself is 3 hours. And if you do the math, 3 hours will simply translate into 180 minutes. Abi? So, and it makes sense to look at in 180 minutes, you are fighting for 100 marks. You're fighting for 100 marks in 180 minutes. So you need to understand that every minute, or how many minutes do you need per mark? For you to get a mark, if you divide 180 minutes divided by 100, so for every 1.8 minutes, you should have gotten 1 mark. So these 20 marks now, if I simply multiply by 1.8, that will give me a sense of this 20 times 1.8, which is around 36 minutes. This will give me a sense of how many minutes I have to spend on this question. 36 minutes. So after this class, you must be able to solve this question under 36 minutes. Because when you're spending above that in the exam, you would probably already be losing mark in some other questions. So now, let's now read the question. It says, ORAC Limited is a specialist computer components manufacturer. The company presently has a staff strength of 54 employees, and it has 2 customers located in the southwestern part of the country. However, the relative success of ORAC Nigeria Limited over the last few years has attracted interest from a number of potential buyers that want to acquire the company. One of ORAC Nigeria Limited's main customers, Datamatic PLC, is now considering making a bid for the entire share capital of ORAC, thereby effectively bringing oral services in-house. Datamatics is of the opinion that the specialist products that ORAC Nigeria Limited supplies, it will not be under their company's control. The financial advisor of Datamatics has obtained the following information relating to ORAC Nigeria Limited. So we're given extracts from financial statements of ORAC Nigeria Limited for the year ended September 30, 2023. So they gave us these extracts. And I've said that information obtained from Computer Component Manufacturers Association are this. So this is more of the industry ratios of other companies in the same industry as Oracle. This is it. We are told that the finance director of Datamatics has provided the following summary of Datamatics' recent performance as accepted September. So this, they give us the performance of Datamatics, its revenue, its pre-tax profits, and the dividend it pays. So they want us to compute this ratio. So let's start one by one. The first ratio we're asked to compute is gross profit to capital employed. Gross profits to capital employed. You see, the way this ratio is presented, we can easily get its formula from the way it's presented. Gross profits to total capital employed, or to capital employed. It goes to show that its formula is simply gross profits over capital employed, of course, multiplied by 100/1. And the interpretation, or what it means, is simply the amount of gross profits that an entity makes from the capital it's invested. The amount of gross profits made by an entity from the invested capital. From this question, from the information given to us, they give an extract of the financial statement of Oracle. But how can we get the gross profits of Oracle in this case? Because we weren't given directly. But I sense we can compute it. I would want you to bring out your calculator at this point, because I can't be teaching and being the one pressing and giving you figures at the same time. So I wouldn't mind you unmuting yourself if you are not in a noisy environment, so that you can participate actively at this point. So can somebody give me the gross profit of Oracle? Or how do we get it?
95,130.
95,130. How did you get that?
That's the revenue minus sales. Cost minus, where is it? Go back to the something, sir.
Revenue of 220 minus cost of sales of 820. That's the gross profit. Okay. So what is the capital employed?
Capital employed will be non-current assets plus working capital.
Where is working capital now?
Current asset minus current liability plus net
Capital employed. Capital employed will be ordinary share capital plus retained earnings.
Exactly. That's the best way for you to compute it in the exam. Please, that's the easiest. That's the approach I would advise you to use. So when you
The ordinary share capital. plus retained earnings. Because the capital employed is the owner's, how do they put it? Is the equity.
Yes. Yes. So, as I was saying, that's the best approach for you in the exam when it comes to calculation of capital employed. So, you have two options. You have two options for computing capital employed. It's either you simply use equity, which is ordinary share plus reserves. In this case, the only reserve we have is retained earnings, or you use equity plus long-term debt or fixed interest debt, like loans or debentures or any other debts that you pay interest on, provided it is long-term. In this question now, we don't have any long-term debts. If we had, our capital employed would have been equity plus that long-term debt. That's the easiest way to get it. But because they did not give us long-term debts, then our capital employed can simply go for just equity, which is ordinary share capital plus the retained earnings. So if you sum the two together, what will it give us?
Please take away the cursor. 9,500.
9,500.
Yeah.
9,500. Okay, multiply by 100. What would this give you?
99.68 or 69%.
Okay, so that's our gross profit to capital employed. Now, I need you to note something, or let me do the second one, then I would let me just compute the second ratio, then I would explain that. The second
It's
ratio
the same, it's the same answer, sir.
okay, good. The second ratio is pre-tax profits to capital employed. Pre-tax profits to capital employed. Now, who can tell me from your understanding of that first formula, what do you think will be the formula for the second one?
Profit before tax all over capital employed times 100 all over 1.
That's correct. Profit before tax over capital employed times 100 over 1. So the question, did they give us profit before tax in the question? Let's go to the question. Are we given profit before tax? Yes, can see it there. They give us our profit before tax as 17,100. I hope you can all see it. 17,100. So our profit before tax is 17,100. We can just use the capital employed we computed above, which is 95,400 times 100. What does that give us?
$17.92.
17.92. Let me just use one decimal place. 17.9%. Okay. Now, do you know that if the question had given us long-term debts for this first one, my capital employed will have been equity plus that long-term debt. Like maybe they gave us long-term loans or long-term debentures or long-term preference shares, that is debt. I will have added that to equity to get my capital employed for this one. But you see this second one that I'm using PBT, you know that even if they gave me long-term debt, I wouldn't have been able to use it. I will have used just the equity. I will have used just the equity. And the reason is because PBT, similar to PAT, the difference between them is just tax. Is a profit that belongs to equity holders, that belongs to our shareholders, of course, after we have paid government. So when we want to get pre-tax profit to capital employed, we have to be comparing like with like. It's going to be that PBT on the money invested solely by the equity holders, because this profit belongs to just the equity holders, because this is PBT. It's a profit after you have paid interest and almost all other expenses. But you see, this gross profit is a profit that belongs to everybody, including even the debt holders, because at this level, we have not settled our interests. We have not paid the debt holders. And that's why the capital employed you would have to use at this level would be the equity plus debt, if given. But because we don't have that, so we can easily escape with just using equity since they give us extracts like that. So I'm just saying this just so that in case that complete information is available, if you use that equity plus debt in case of gross profits, which is a profit that belongs to all the contributors of capital, this particular one belongs to only equity. So the capital employed we can use there has to be only equity. Just to be sure that you understand the point I've just made, what if the examiner asked you to compute operating profit to capital employed? So the capital employed you would use, will it be just equity or equity and long-term debt?
Equity and long-term debt.
Why?
Because they finance what's it called? For the long-term debt, there's always a charge called, it could be finance charge. So it hasn't been deducted already. It hasn't been deducted as at that time. But
That's correct.
before tax, it has been deducted already. So to include it, there will be a double deduction or something like it. It will amount to double or give a wrong reflection of the ratio.
That's correct. So if you're asked to compute operating profit to capital employed, that operating profit is a profit that belongs to everybody. So the capital employed you would use would be equity plus long-term debts. Good. So you get a point. Again, who can tell me what this ratio measures based on what I told you in the first one? What do you think this will measure?
I think it mentioned I think it has to do with the investment ratio, the ratio that has to do with investors. So you try to see how well the capital employed has been utilized when you compare it to profit.
Okay, well, not bad, but I would have loved to be more specific because otherwise you'll be interpreting the two the same way. You know, I told you that this 99.7% would mean that we have made 99.7% gross profits from our capital employed. So it's the amount of gross profits made from the capital invested. This would then be the amount of pre-tax profits made from the capital invested. So we have made 17.9% profit from our capital invested. But there's a dramatic fall between this gross profit to capital employed and pre-tax profit to capital employed. It's huge. What will have caused that? There's a huge fall between the gross profit to capital employed and pre-tax profit to capital employed. That shows that between the gross profit, the capital employed didn't change. What changed majorly was the gross profit and the pre-tax profits, which goes to show that the company is spending heavily on overheads because their admin, their distribution costs, their finance costs has to be very heavy, which is why their pay to capital employed is 99.7%, and pre-tax profits came all the way down to 17.9%. So those are points that we will need to note for our analysis, but I mean, point to note. Okay. And yeah, these two are profitability ratios, not investors ratio. They are profitability ratios. They measure profitability.
Hello, sir.
Yes.
If we minus that 17.9% from that 99.7%, the difference will now be the effect of the both admin and non-admin expenses, Abi?
Overhead.
Am I correct? Are you there, sir?
Hear me? Hello, can you hear me?
Yes, sir. Yes, I can hear you, sir.
Okay. So, Latif, can you repeat your question?
I'm just trying to figure out something there that if we have to minus 17.9% from that of the 99.7%, then the differences between the two will represent the effect of the business expenses, Abi?
You cannot look at it that way. All we can say is that what has caused the significant reduction are the overheads and finance costs.
Okay.
That's the best we can do. Okay, let's go to the third ratio, which is gross profit margin. Gross profit margin. And when it comes to gross profit margin, the formula simply is gross profits over what?
Yes.
Over sales. And this ratio measures the amount of gross profits that is made on every sales. First times 100 over 1. It measures the amount of gross profit that is made on every what? Every.
Yes.
You will see the interpretation, they look similar. Look at this one. The amount of gross profits made on capital invested. The amount of PBT made on capital employed. The amount of gross profits made on every sale. So there is no difficulty in its interpretation. Even looking at the name itself, you can originate the formula. You can originate the interpretation. From up here, we can simply obtain our gross profits. Then we have to go back to the question to get our sales. And what's our sales? Which is the revenue? 229.50, right?
Yes, sir.
229.50 times 100 over 1. What would that give us?
That's 43.05.
43.05%. That's our gross profit margin. So that means we have made a gross profit of 43% on every sales. That's not bad. If you are doing that as a business, you're doing well. That means if you are selling, if your selling price is 100 naira, that means your cost price will have been around 100 minus 3, which is not bad. Then the next ratio is, what's the next ratio? Net profit margin.
Net profit over sales times 100 of
Thank you very much. And what would that mean? What does it measure?
the amount of net profit we have gained from each sales.
That's correct. The amount of net profit made on every sales. But now, what is our net profit from here now? Looking at this question. What do we use our net profit?
Let's see it. Our net profit will be
Profits for the year.
That's correct. That's correct.
11,970.
For the year, yes, 11,970. Always use profit for the year for net profits, 11,970. And for our sales, we can easily pick it from here. So I won't have to write it. Can easily pick it from here. Multiply by what? 100 over
100. That's 5.4.
Wow. What a
0.42.
reduction. What a reduction. Look at it again. Their GP margin or gross profit margin was 43%. Look at the fall when it comes to net profit margin. Again, this also corroborates my first hypothesis that this company is incurring hugely on overheads and finance costs. Because please tell me, why would there be this such fall from gross profit margin to net profit margin? I'm going to, of course, put this in my interpretation, and I'll definitely advise the company that they would have to improve in cost management techniques to find a way to up their net profit margin. I mean, if they are doing 20% net profit margin, it's okay, considering the fact that their gross profit margin was healthy. The fall is too much. If you are not careful,
Hello, sir.
before. Yes, Latif.
I want to guess that Datamatic is a company in Nigeria, in a Nigerian scenario. So that's why the net profit something is.
Not that I'm this Oracle. Maybe you're talking about Oracle.
No, I'm only okay.
Yes,
I only
I get what you're saying. I get
station.
what you're saying. Because of the current economic environment, right?
Yes, sir.
Well, I disagree with you because yes, as things are getting more expensive, companies are also increasing prices. So it should net off, right, for them.
Over 50% of the companies are leaving the country as well because they cannot meet up with the working their whatever overhead expenses.
Be very careful in saying that without sufficient data, which we
You know now, you are a professional now. You
I
know
don't
now.
know. No, I don't know. You have to do a proper research to make such a statistical statement that over 50%. You will say companies are leaving Nigeria. It's okay, but not 50%.
Okay. Thank you. I got it, sir.
Yeah, you'll be shocked that it's significantly lower than that. Okay, so the next one is non-current assets turnover. Yeah. Also, may I mention that this gross profit margin and net profit margin are also profitability ratios as well. So these four are profitability ratio. You see, this particular one that we solved next in this number 2, we can conveniently call it return on capital employed. Even this as well, we can call it return on capital employed. You see, this is the first time the examiner was very specific with regards the profits they need you to use. You see, when they say return on capital employed, you could probably do GP over capital employed for them. You can do PBT on capital employed for them. You can do operating profit on capital employed for them. You are correct. But in this diet, they were so specific. in regards to which return on capital employed are we looking at. It looked at the gross profit on capital employed, also looked at the PBT on capital employed. All are profitability ratios. Now, the fifth ratio required by the examiner was the non-current assets turnover. Non-current asset turnover. So, what do you think this formula would be?
Turnover means sales.
Yes.
It will be non-current all over turnover.
It will be what?
Non-current assets all over turnover.
We are
Non,
looking at the relationship between the assets and the sales. In other words, the value of the assets that was used in generating the sales or something like that.
okay. Good idea from you guys. Um, okay. So this is actually not correct. Okay.
Okay.
It should be the reciprocal of this. It should actually be turnover over non-current assets. And the examiner was also very specific with regards to the asset they want you to use, the non-current asset. In some questions, they will just say asset turnover. If they just say asset turnover, that means instead of non-current assets, you're going to be using total assets. So here they want you to use non-current assets. So, and also, as Oliver tried, he said the assets available to generate, or how did you put it, Oliver, again, please?
Yeah, I'm saying that we are trying to look at we are looking at sales and also looking at the assets, the relationship between the sales and the assets, the extent to which the asset was used to generate the sales.
Okay. So the extent to which the asset was used to generate the sales. Okay, don't look at it like that. Look at it more of the amount of sales, or how many times, or the proportion of sales that was generated from the use of our assets. Okay, I think that's more like the reverse of what you're saying, or maybe that's what you mean as well. But
Yeah,
in proportion of our sales that is generated from the use of our assets, or to put it accurately, it is the number of times we're able to generate or convert our assets to sales. The number of times we're able to convert our assets to sales. That's this non-current asset turnover. So without even going back to the question, I already have my sales. I already have my sales here. But I will need to
229.
go back to the question to get my non-current assets. And my non-current asset here is 8460, right?
Yes, sir.
yeah.
8460. So is it okay for turnover to be higher than non-current assets? And you accountants should know this. See, that's why you would find that a company like Tesla, for example, now will be worth much more than a company like Mercedes-Benz or Toyota. I mean, from so many years ago, they have been worth more than them. I mean, at that point in time where Tesla was only selling few cars, they have not started selling so much. But when you, as at that time, investors, when they looked at the asset turnover of Tesla, they saw that this guy asset was very minimal, and his revenue was much more than its assets. It wasn't accumulating unnecessary fixed assets, and he was able to scale. And in fact, whenever they sell a product or a car to you, That's not the only revenue they make. They have a subscription-based revenue they make from software upgrade and some other apps that they sell to you on that car that you have bought. The asset turnover was impressive. Unlike the other conventional car makers that hold a lot of inventory, that hold a lot of fixed assets everywhere, all over the country. So you find them having a very low asset turnover. See, one of the way of measuring efficiency, this is an efficiency ratio, and it's extremely significant for any business to have its turnover much more than its non-current assets. And that's why you find that most investors will really want to invest in most of these fintechs, right? Because you will find them having branches everywhere, holding structures, paying rent. I mean, the most of the asset they would have physical would be maybe a single office. In fact, most of them will work remotely, and they're making huge turnovers. When you check their asset turnover, is impressive. They are efficient. That's efficiency. Again, the recently issued accounts of Nigerian banks, GT Bank, Zenith Bank, when I computed their ratios, I looked at it. I saw that even though Zenith Bank was doing much better in terms of interest income, fees and commission income, and net trading income, which put together will give us their gross income. But when you put it on total assets, you find out that GT is more efficient. They were more efficient. And investors will favor such a company because it means they can scale. So your asset turnover should be as many times as possible. When you find businesses that their turnover is 100 million, but their asset is 500 million, yeah, on a long thing. So how much is this? What would this give us?
2.75 also.
0.75.
2.75 times. Okay. The exam, this is how you put it. Times is in. So it shows that this company is able to convert his assets 2.75 times to generate, which is not bad. See, some companies doing 6 times. Some will do 10 times. The higher, the better, of course. Now, the next one is receivables collection period in days. They put in brackets days. Number 7, receivables collection period. So what would this mean?
Receivable all over credit sales.
That's correct. So don't just say receivables, put it as trade receivables all upon credit sales. And please don't forget to put 365 days. If you don't put 365 days, you are wrong. The examiner will mark you down. And again, you don't make the mistake of doing reciprocal of this. A lot of students looking at their scripts, the examiner noted that they were doing a reciprocal of this. They were doing a reciprocal of this. They were doing credit sales over receivables. They were doing credit sales over receivables. Find a way to not make that mistake in the exam, because you will still find this in your exam. So receivables collection period, just since it's starting from receivables, just know that your formula is start from receivables, trade receivables, and the related item to trade receivables is credit sales multiplied by 365 days. If the examiner has put months in brackets, even though in 99% or in almost 100% of cases, they are always in days. But in case they decide to put months or years, so that means you would not be multiplying by 365 months. In the case of months, you'll be multiplying by 12 months. In the case of years, you multiply by 1. So from the question, what's our trade receivables? So they gave us our receivables as 13,140. 13,140. And our credit sales is 22,950. Multiplied by what? 365. So how many days is this?
21.7, 22 days.
So you don't need to put this one in decimal. 22 days. Okay. Let me see that person that's disturbing the class. Latif, you are the
Sir.
one.
No. Not me, sir.
Okay.
That voice was female voice now.
Okay. So who can tell us what does this 22 days mean? What does it mean?
Number of days that credit is granted to customers.
Wrong. That's not correct.
It measures how quickly payment from credit sales are recovered.
That's correct. You know that what Reginald said is different from what you said, Latif.
Sir?
You know that what you said is different from what Reginald said.
It's just an English interpretation. We mean the same thing.
It's not true.
Okay, can you say it again, sir?
You said the days are granted to the creditor.
No, say your word.
But
Say
he
your
is
word.
saying
Say your word.
the number
Say
of
your
days it takes to collect is a different thing.
Yeah, sure. They're not the same.
They're not the same.
So this is how many days it takes you to collect your money from your customers. How long it takes you to collect your money from your customers. You know that the earlier the better. A company that
Yes.
is able to collect its money earlier is more efficient, so that you can use that money to do something else. So that's receivables collection period. So I want to guess that the next they will ask you to compute is payables payment period. And what will be the formula for payables payment period?
Payables all over credit purchases. That's
Credit
360 days. Payables.
over
Credit
credit
purchases.
times what? 365 days. But in most questions, you find out that they will not give you credit purchases. So what would you use?
That's cost of sales, I think.
Yes, you can simply use your cost of sales because you find them not giving you these credit purchases. Just use your cost of sales, please. So let's go to the question and get our trade payables and cost of sales. Our cost of sales is 125,820. I want somebody to cram that 125,820. And our payables is 21,960. I'm going to cram this one. Everybody cram this 125,820. So 21,960. 21,960. So what's the cost of sales?
125,820.
Thank you. 125,820. Multiply by 365 days. So multiply by 365. So that's how many days?
2.09.
Again?
That's 2.09. What I get it. That's two days.
That's 2 days. That's
No.
2 days. Just give me a second. I think Mr. Adejuwon is returning my call. Remember he missed your class. Let me hear what he wants. Okay, sorry. So these 2 days, are you sure we will not confirm his figure?
No, it's not 2 days old. This is 4 days.
It's 4 days.
This is 4 days.
Okay.
Yeah.
So somebody's
64
asking
days.
that. Oh,
64 days.
64 days. So what would this 64 days mean? The number of days it takes
No, to pay
exactly
that. Mm.
to pay our suppliers.
Mm.
The number
Okay,
of
this is
days it takes to pay our suppliers. So is it the
sorry.
higher the
So,
better?
sir,
Yes, Latif.
I'm sorry since I made a mistake in my answer. So it is 21,960, Abi.
Yeah.
Yes.
Oh, sorry, I'm sorry.
So for this payables payment period, is it the higher the better or the lower the better?
Yeah, the better.
The higher the better.
The higher the better. Okay. So can you justify that? Explain that. Why?
If it takes you more time to repay your creditor, you have enough money to run the business. So it's working capital efficiency.
The higher the better.
Yes.
So it take a little time. How does it? It take you a longer time to pay your debt, but it take you a shorter time to recover your debt. So it helps you with your what's it called, your working capital management.
Yeah. So I won't say you're wrong. I share your view as well. At the same time, if you know the meaning of what Latif said, so I think is implying that why would you be using your suppliers' money to run your business? You're not supposed to use suppliers' money to run your business. I don't think that should be the hallmark of efficiency. Remember that the supplier actually gave you these goods for free. Sorry, on credit, free credit. It didn't even charge you interest. So how would you now sell those goods? You got the money, you now did not pay. You now kept the money,
As it goes,
using it to
as
run
it
it.
goes, based out.
Sorry?
Now the thing is, take for example, now we are looking at a company. It takes 64 days to pay back, but it takes you 22 days to recover. So the difference here is almost like 42 days or so thereabouts.
So why are you holding your supplier's money for 42 days?
Well, it depends. It depends. If what's it called? If the market is competitive and they are looking for market, they can allow you to hold their money.
So why are you holding money? Don't you want to continue to sell more goods? Why not pay
No,
them?
of course you sell more goods now. Well,
No, no.
anyway, we don't have the full picture of this, and maybe the number of days is quite high. Maybe.
Yeah. So I mean, you're right. I just want you to look at it in a robust manner, especially
Mm,
for people's payment period. It should not be one-sided. It's dangerous
yeah.
for you to analyze it and say the higher the better or the lower the better. Because we need to have information about one, the credit period given by the supplier first. So if the supplier has granted you, let's say 64 days, and you're paying within 64 days, fine, that is good. If the supplier has given you 50 days and you're paying in 64 days, that is bad. That is not good. Furthermore, if you're having increasing payables payment period, that could signify that you don't have cash flows, you don't have money, you have liquidity problem, and you're only relying on your supplier's money to run your business. So it's a going concern threat that we need to be on alert of. But by the time you compute for this particular, if I want to judge from this particular company, looking at its gross profits on capital employed, looking at its gross profit margin, net profit margin, asset turnover, is a profitable company. And I want to believe that if he is doing 64 days, okay, I want to believe it's because he was able to negotiate an extended credit period with its suppliers, and the supplier will have agreed because, I mean, he is a profitable company. Again, I would also want to compare with what industry is doing. Industry is doing 34 days. Okay, people are paying earlier, but he is doing 64 days. So For me, I would say it's a strong company. And because it's profitable, supplier are ready to give him an extended credit period. Because I don't have the full picture. That's how I'm going to do it. But if it was a company that is not so profitable, I would have said that having an extended payment period might indicate liquidity problem. And if I now compute my, let's say, quick ratio or current ratio, and I see that is low, I would refer back to this one. That this quick ratio that is low also corroborates the fact that the reason why he's holding its suppliers money, it's taking him a longer days to pay suppliers than industry, is because he doesn't have liquidity. So extended payables payment period, I don't like interpreting it from the standpoint of that because you can hold the money and use it to run your business. Run your business to do what? Is it to pay salaries or what? To pay rent? So what do you want to be using your suppliers' money to do? As soon as you get suppliers' money, pay the supplier so that I can give you additional goods so that you can continue to run your business, because that also impacts your operating cycle.
And that profit margin will increase than
Exactly.
99%. So that's why it is not good that the payment period is higher.
Exactly. But I mean, I won't say it's not totally good because I don't have the complete information. And again, this company looks strong. So I could possibly say that, yes, they were able to get extended credit period. And again, when you're having decreasing payables period, for me, it would mean that this company is selling fast. They are making huge turnover. And that's why they are able to pay their suppliers early enough, and which will also increase their credit rating as a business. And the supplier will be willing to give them even extended credits. Maybe that was what got this guy to this point. Maybe. So you need to look at it from that side when it comes to analysis of payables payment period. The next ratio here is inventory turnover period. Inventory. So what will be the formula for this? Reduce average or closing inventory. Input this or in statement form, or closing inventory divided by what? Your cost of sales multiplied by what? 365 days. Average or closing inventory divided by cost of sales multiplied by 365 days. In the exam, I would always advise you to go for closing inventory. Don't do average. It might run you into problem.
Why are we
Average.
using cost of sales? We're saying turnover.
Oh, okay. This turnover does not mean anything because there's turnover. There can be turnover in these ones too. This one also that they call receivable collection period. You could also call it receivables turnover period. So the only item that relates to your inventory that you are holding is not the sales. What creates inventory is not sales. What creates inventory is purchases, both opening and closing and other. So it's your cost of sales. What creates trade payables is purchases. Why you're having trade payables is because of purchases. What creates receivables is credit sales. So when it comes to these three, you need to know the relationship between the numerator and the denominator. They are closely related. So when it comes to inventory turnover period, so don't use sales here, okay? Remember that what comes first is the inventory. In the exam, I'm saying use closing inventory. The related item to closing inventory or what creates inventory is your cost of sales. It's because you purchased and some other inventory you have in store before which is your cost of sales altogether. That is what created your closing inventory. So let's check the question for our closing inventory. So the question gave us our inventory as 2880 divided by cost of sales. We use cost of sales here, 125,820 multiplied by 365. So how many days is that?
50, that's 60 days.
Let's confirm his figures. So now he has history of giving wrong figures.
61 days. 61 days.
What did I say?
Yeah, it's 60.57. So
Yes, 61 days. So these 61 days,
2880.
what will it mean? Inventory turnover period.
Number of days, number of times that inventory, or okay, number of days that it takes to convert inventory to sales.
Okay, that's not bad. That's not bad. So, and it can also be the number of that. It took us 61 days to sell our inventory, or the number of days we held our inventory before we eventually sold it. That's inventory turnover period. And obviously, the shorter, the better. It's better you sell as fast as possible. It's better you sell as fast as possible. So that's inventory turnover period. So the next one here is,
Hello, sir.
yes, sir.
Sorry, sir. I want to believe that from number 5 to 8 are efficiency.
Yes. Yes. Non-current asset turnover, receivables collection period, payables payment period, inventory turnover period, they are all efficiency ratios. They are all efficiency ratios. So number 9 is asking us for revenue per employee. So how do we compute this?
No.
No. What do you mean you don't know? This is a basic requirement. There's nothing special in this. You should know.
Okay,
Can
sir.
anybody tell me?
Revenue means sales, sir.
should we check look at the relationship between revenue and employee? Maybe
Yeah.
sales and salaries or something like that.
So which formula should you use? Revenue per employee.
It should be what's it called? It should be, if there's anything like salary accounts there, then over revenue.
Okay. Can any other person give me some trial? Revenue per employee.
Let us look at the question. The figures
What are you looking? There's no question. It's revenue per employee.
as in the figures that we are giving, that we've been using.
You don't even know the formula. So how would you know the figure you want to use?
If you want to know their why I'm so confused is that how to get about per employee. That's just
Okay, so just this thing is just as it is. Why are you complicating it? Revenue per employee. It's just, I want to know my revenue per student. For equity now, I want to know my revenue per student. Like I
okay.
run a tailoring business, for example. Now I have 20 employees. I want to know what's my revenue per my employee. is, I don't think there's anything serious there that you need to. Thank you, Aisha. Is revenue divided by number of employees.
Let's see how employees.
The revenue I make per my employee, revenue divided by number of employees. Because last diet, I did not teach them this one. Nobody will teach you this one. Nobody is going to teach you. And you should not get it wrong because it's very straightforward. So I have my revenue. What's our revenue? 229.50. 229.50. He gave us number of employees in the question. They told us we have 54 employees. They said, Oracle Nigeria Limited is a specialist computer component manufacturer. The company presently have a staff strength of 54 employees. So we have 54 employees. So how much is this guy making per employee?
4,091.
Sorry?
4,092. 4,092 naira.
Because let me quickly put it in like this, because of the level of rounding off is in thousands. Why I'm doing that is because the industry, average revenue per employee in the industry is 2.3 million. So you need to know that this guy is doing better than industry. He is doing 4 million per its employees. It's a good company. I mean, he's not just employing people, sharp. He's able to scale. So number 10, this is looking at dividend cover. Dividend cover. So dividend cover will simply be profit for the year divided by dividend paid. That's dividend cover. So from the name cover, dividend cover. What can cover your dividend is your profits. It's your profit that covers your dividend, that protects your dividend, that pays your dividend, is your profit. So we are looking at how many times can we pay dividend from our profit. We just want to look at our bragging rights, something like that. How safe are we from investors' standpoint? Dividend cover is more of an investor's ratio. In fact, it is an investor's ratio. So we just want to look at how many times can our profits pay our dividend. It's just for us to brag. It's just for us to justify whatever dividend we are paying right now. That even if we decide to pay this same dividend 10 times, we can do it. Something like that. So that's dividend cover, right? So from the question, what's the profit for the year? Profit for the year is 11,970. What's our dividend paid? 5,850. Me, I would cram this 5,850. One of you should cram this 11,970, which is so give me the profit for the year.
11,970.
And this is
58.50. 5,850.
so how many times?
2.1. 2.0.
Okay, that's like 2 times. That's two times. So you remember that this is times, number of times. Number 11, this speaks to current ratio. So your current ratio is current assets divided by current liabilities. This is current assets divided by current liabilities. So this ratio majorly looks at the ability of a company to pay its current liabilities from its current assets. And usually this ratio, we expect a minimum of 2 to 1. 2 to 1. That is, your current asset should be 2 times your current liability. This ratio, this 2 to 1, should help you always remember this formula. That your current asset should be 2 times your current liability. So you should know that your current asset comes first, divided by your current liability, so that you won't find yourself doing the reciprocal of that. You will now lose 1 mark in the exam. So, did they give us current assets? We were not given current asset directly, but we can sum 1 or 2 together to get current assets. I will cram inventory of 2880. Latif, cram receivables 13150. Oliver, cram 2880. Okay? Have you crammed it?
Yeah, 2.
Okay.
Okay.
My own is inventory. Inventory 2880. Latif, give me your own.
18140.
18140. Oliver, give me your own.
2880. 2880.
Good. Oh, I will have asked somebody to cram the liability. Okay, let's go for the liabilities. They only give us payables. So I can just go straight on to use 21,960. So 21,960. So can you add this 3 divided by 21,960?
36,900.
Okay, 36,900. Yeah, divided by 21,960.
We have 1.68.
We have what?
I have 1.8.
Let's say 1.7 ratio 1, Abi.
Yes, sir.
Let's do 1.7 ratio 1. So, and the last one the examiner wants us to compute is quick
Is that what you get? I'm getting 1.9.
1.9. Let's go over it again, please. Can we? Can we go confirm?
$1.9.
Still 1.9.
Yes. 1.91.
So Latif, let's give you opportunity to reconfirm so that we will not discard the figure like that.
Sir,
Yeah,
are you there?
not there.
Oliver, if we add the 3 together, I got 41,900. Is that correct?
I got 41,900.
Me too now.
Then divided by 21,960.
Okay, 1.9.
I will not be believing your figure again.
Yes, sir. Thank you, sir.
So how do we get quick ratio? Quick ratio is current assets minus inventory divided by current liabilities. So this ratio and this ratio, they are liquidity ratio. While this one, the standard is 2:1, and this one is looking at the ability to cover our liabilities with our current assets. This one is even looking at a more liquid assets available to cover our liabilities. That's why it's removing inventory from the current assets. That do we have the ability to cover our liabilities with our highly liquid assets? Because we believe inventory might not be easily liquid, might not be easily convertible to cash. So let's remove it and let's see whatever we have left. Can we easily use it to settle our liabilities? You see, usually a 1-to-1 ratio seems okay. Okay, a 1-to-1 ratio seems okay. But in this wise now, since the examiner didn't give us current assets, they gave us these items piecemeal or one-on-one. So our current asset minus inventory will simply just be that exclude inventory, because this is the inventory figure, in that we'll just take just these receivables and cash alone. Okay, that means we have already removed inventory, which is this. So then all upon my payables of 21,960. What are we looking at?
I don't want to talk again, so I'll not give you poisonous figures.
This was also
Better talk right now at this moment.
I have 21,020, 2120.
Okay,
Current
so
asset minus inventory.
what would that give us? 0.95 watts. Have you confirmed? You see, that's why the receivables that I asked Latif to cram is 13,150. Latif gave us 18,150.
13, I didn't say 18, sir. 13, it was you that. I know it.
Which I think is why you got 1.7. Because I saw another person to confirm that 1.7.
so it's 13,140, right?
Yes.
Yes. I think I deserve to say to receive apology for.
Only Jacob. So this will be 0.7 times. This company is not very liquid because it's less than the standard of 1-to-1. What am I writing? 0.7 times 0.7 ratio 1. And this explains why they are having an extended payment period. They are just holding that money because they're not so liquid. Look at their quick ratio now, it's poor. So these are liquidity ratios. These are liquidity ratios. Okay, that's 12 marks. Now, the B part says we should analyze the position and performance of ORAC Nigeria Limited for the year ended September 2023 and determine if Datamatics will investments in ORAC will be what they were. So let me show you how to analyze this. So usually, this one is a little straightforward because you're only asked to compute ratio for 1 year. If you're asked to compute ratios for 2 years, analysis would involve comparing 1 year with another. But in this case now, they want you to compare these ratios for this current year of this company with industry because they gave us the industry ratios. So the B part asks us for analysis of financial performance and financial position of ORAC Nigeria Limited. So how do you analyze to ensure that you get all 8 marks? So you have almost 12 ratios here. See, I can conveniently talk about each of these ratios one after the other within few minutes, and that will have covered my analysis, and that will give me automatically all my marks. Okay, I can conveniently talk about them. So the one that they gave me industry average for, I would simply compare it with the industry average and make one or two comments on it. So let me show you how to do that in the exam. So I will start with my gross profit to capital employed of 99.7%. So I will say that I will say the gross profit to capital employed of 99.7% is impressive, and it shows that the company makes huge gross profits on the capital invested by the owners. That's that. However, let me keep it simple for you. You go to the next one. You say the pre-tax profits to capital employed of, that one was how many percent? 17.9% is low when compared with the gross profit margin. The gross profit to capital employed. A 17.9% ratio shows that the company makes 17.9% pre-tax profits on capital invested by owners. The relative flow ratio can be attributed to huge overheads and finance costs. To stop. They didn't give me industry average for pre-tax ratio or pre-tax to profits to capital employed. So I can't really see anything around that, whether they are doing fine from that standpoint. Then I go to my next ratio, which is gross profit margin. Say the gross profit margin of 40, I think 43%, I mean, or 43%. Did they give me industry average for that? Gross profit margin for industry? No, we're not given. I wasn't given. Is also impressive, and it shows that the company makes 43% gross profits on every sales. On every sales. Full stop. So there's nothing to compare it with. That's why I just tell the examiner the. You see, from the three ratios I've computed, you will see there's a sequence. There's a sequence which I need you to note. First, I mentioned the ratio. And because I can't compare it, this one I don't have anything to compare it with. I can't say whether it's improving or not. But I know that 99.7% is not bad. After I've mentioned, I said it's impressive. Then I tell the examiner what that ratio means. I tell them what it means. It's important you're able to do that because it shows that you know what it means. That's analysis. So it shows that the company makes huge gross profit on the capital invested by, which I also did here too. Even though I try to compare this pre-tax profits with the gross profit to capital employed. So I compared it with it that okay, it's low relative to that. But I later also told the examiner the meaning of this ratio. I said a 17.9% ratio shows that the company makes 17.9 pre-tax profits on the capital employed. So in the exam, if you don't, you might not necessarily say this. I mean, it makes sense if you can mention why it is low relative to the gross profit employed. This one also, the same approach. That's the same approach I use for everything. For you guys, that's just the best you can do. I said the gross profit margin of 43%. I said it's also impressive. And it shows that the company makes 43% gross profits on every sales. On every sales. I just told them the meaning. The same thing applies to the net profit margin of, I think, 5.4% or thereabouts. Let's see. Yeah, 5.4% is, I think they gave us something with tax margin. I can use that as a basis. Yeah, average tax margin of 5.1%. So is higher than the pre-tax margin of the industry. This shows that the company makes more net profits than on every sales than other companies within the what? Within the industry. You see, this analysis will not take me a few seconds to put up. So I can analyze everything in such a way that I will get 8/8 because I've analyzed all the ratios I computed and I'm not taking so much time. I will go to the next one, which is my non-current assets turnover. I will look at the industry average they gave me. I was not given a comparable ratio. So I will just do, this is 2.75 times. The non-current asset turnover of 2.75 times looks okay. Yes. And this shows that the company is able to convert its assets, its non-current assets, to sales 2.75 times. Simple. I go to the next one. Receivables collection period. What's the industry doing? Industry is doing 78 days. I'm doing 22 days. I'm better than industry. The receivables collection period of how many days? 22 days is better than that of industry of how many days? Of 78 days. This shows that the company is able to recover its money from customers earlier than most companies within the what? Within the industry. Then the payables payment period of 64 days, industry is doing 34 days. I'll say the payables payment period of 64 days is longer than the industry average of 34 days, I guess. This shows that the company is taking a longer time to settle its suppliers because it might be facing liquidity issues, which is also confirmed by its low quick ratio, which is also confirmed by its low quick ratio of 0.7:1. Are you guys with me?
Yes, sir.
Okay. Then inventory turnover period of 61 days. They didn't give us the inventory turnover period for industry. So I'll just analyze it with respect to itself. The inventory turnover period of 61 days looks long. This shows that takes the company 61 days before it can sell its inventories. Revenue per employee of 4 million. The revenue per employee of 4 million is better than average industry of 2,313,000. This shows that productivity of the company's employees is higher than most companies within the industry. Dividend cover 2 times. They give us dividend cover for no. No. The dividend cover of 2 times shows that the company can pay its dividend from its profits 2 times.
And it is a plus.
The current ratio of 1.7:1 is lower than the standard 2:1, and this shows that the company can only cover its current liabilities from its current assets at a ratio of 1.7:1. The quick ratio of 0.7:1 is also lower than the standard 1:1. This shows that the company cannot effectively cover or settle its current liabilities
from the current asset.
its available liquid funds. Following from the above ratios, ORAC Nigeria Limited is profitable from the standpoint of gross profits with tax profits and a profit for the year. The company is also efficient. Considering its receivables collection period, but its liquidity issues makes it takes longer to settle its suppliers. This liquidity issue might partly be as a result of slow moving inventory, as it takes the company 61 days to sell its inventories. If data mix can invest cash flows into Aura, it can improve the liquidity position and efficiency of the company, thereby making it a viable investment decision. We therefore advise that data mix should invest in ORAC Nigeria Limited. Okay, so this is me keeping it simple for you, because I'm assuming I'm also writing the exam. And would you be able to do this in the exam for 8 marks?
Try.
But this is actually this is a very simple analysis, no complexity, straightforward. I will share this thing with you, and I really want you to master the art of doing it this way. It will help you for your exam. Just keep it simple, simple analysis, nothing out of the ordinary. I mean, it's 8 o'clock. I thought I will be able to solve 2 questions today, but unfortunately, we have already spent 2 hours. I have to end the class now. So we'll continue next class with our past questions. So next class, we're going to continue with question 2. And we're also going to solve a question. We're also going to solve last diet question on published. That's question 1 of last diet. So yeah. Do we have any questions?
Yeah, so I do with the topic today, but I think for the past 2 weeks, I've not been consistent with class, not just for FR, but for PM. So how do I get all those videos so that I can go through them?
Sharing it right away.
Pardon?
I'm sharing it right away.
No, not just for this one. Like I discovered that any partial was treated, leasing was completed. I wasn't part of it, those classes.
Okay. I'll share the folder on FR. So if you click that folder, it will take you to all the videos on FR.
Okay, then. Thank you very much. I appreciate it.
Yeah.
Hello, sir.
Yes, Mr. Latif.
I want to assume maybe you will have information for us as regard the return call from Mr. Doughty.
Yes, he was not feeling so fine. So he would he was talking about doing a makeup class after my own class, but I'm not sure that would be comfortable for you guys. So it would I'm sure it would make up. Don't worry.
In line with what the last person just asked, Nasa, last class I was also not in the class. What was the last subject you treated?
I solved questions on leases. I've posted the link to the YouTube to the class, so you'll be able to get all the videos there.
Okay.
All right. So any other issues? Okay. All right. Bye, everyone. See you on Thursday. Please ensure to attend on Thursday. Please don't miss it. Bye.